Life insurance provisions, options, and riders. Required provisions. Insurance clause or insuring agreement. The insurer's basis promise to specify benefits to a designated person in the event of a covered loss. The insuring clause is the part of the health insurance policy that states the kind of benefit provided and circumstance under which they will be paid. The purpose of insuring clause is an insurance policy to specify the scope and limits of the coverage provided. The insurance clause is the part of the insurance policy that identifies specified types of benefits or services that are covered by the policies and circumstances under which they will be paid. Any promises the insurer makes will be in the insuring clause. Consideration clause. A policy owner must pay premium in exchange for the insurer's promise to pay benefits. A policy owner consideration consists of completing the application and paying the initial premiums. The amount and frequency of premium payments are contained in the consideration clause to ensure the insurance companies exchange the promise in the policy for a two-part consideration from the insured. Considerations is an exchange of something of value on which a contract is based. An insurance contract is a valid only if the insurance provider consideration is in a form of initial full minimized premium required and the statement may be in the application. The application begs, please consider me for insurance. Here is the completed application and my initial premium and how much money I have, how often I agree to pay. Please consider me. Entire contract. The entire contract includes the actual policy and the application. It states that nothing outside of the contract includes the signed application and any attached policy riders, can be considered part of the contract. It also assumes the policyholder that no charges will be made to the contract or waiver of any provision after it has been issued, even if the insurer makes policy changes that affect all policy sales in the future. This, however, does not provide a mutual agreement change or modify the contract after it has been issued. Any changes to a policy must be made with an approval of an executive officer of the insurance company, whose approval must be endorsed on the policy or attached in a rider. The mandatory health policy provision states that the policy include endorsements and attached papers constituting the entire insurance contract between the parties. We can't send you additional paperwork later. The entire policy and application is sent to you, and that makes up your entire contract. Grace period. The period of time policy owners are allowed to pay an overdue premium during which the policy remains in force, usually 30 days. If an insured dies during the grace period of an insurance policy before paying the required annual premium, the benefits will receive face value of the policy less any required premium. The purpose of the grace period is to give the policy owner additional time to pay overdue premiums. The policy owner is given a number of days after the premium due date, during which time the premium payment may be delayed or without penalty, and the policy continues in force. Grace period is the same definition for your insurance bill as it is for all your other bills. Don't pick it as an answer if the answer isn't talking about paying your bills. Paying your bill late and keeping your insurance. Reinstatement permits the policy owner to reinstate a policy that has lapsed as long as the policy owner can provide proof of insurability and pay back all premiums, outstanding loans, and interest. Most states allow reinstatement up to 3 years after the policy is lapsed. However, some states are 5 to 7 years. The reinstatement provision specifies that if an insured fails to pay a renewed premium within the time granted by the insurer, authorized agent and company does not require an application for reinstatement. If it takes no action on the application for 45 days, the policy is reinstated automatically. To reinstate any policy, you need a reinstatement application, statement of good health, and all back premiums. Incontestable clause. The clause of life insurance contract that prohibits the insurer from questioning the validation of the contract after a certain period of time has lapsed. Misstatement of age or sex allows the insurer to adjust the policy benefit if the insured age or sex is misstated on the policy's application. The misstatement of age provision allows the insurer to adjust the benefit payable if the age of the insurer was misstated when the application for the policy was made. The insurer can adjust the benefits to what the premiums pay would have purchased at the insured actual age. If the insured was older at the time of the application that is shown in the policy, the benefits would reduce accordingly. The reverse would be true if the insurer were younger and listed in the application. Policy loan provisions. Policies that have cash value also have policy loans and withdrawal provisions. These policies must begin to build cash value after a certain number of years. In most states, this is 3 years. These loans with interest cannot exceed the guaranteed cash value or the policy is no longer in force. The policy owner has the right to the policy's cash value. The policy loans are not taxable. Any loans with interest due at the time of the death will be deducted from the insurable policy's proceeds. Automatic premium loans allow the insurer to automatically use the policy's cash value to pay an overdue premium. There is no cost for this provision. Automatic premium loans, like using a savings account for overdraft protection, but there are no fees, just interest for borrowing your money. If you don't pay it back, interest is added to the loan. It also will subtract from any death benefit or cash surrendered if not paid back first. Owner's right provision defines the person who may name the change beneficiaries, select availability under the policy, and receive any financial benefits from policy. Assignment clause or provision: the right to transfer policy rights to another person or entity. The new owner is known as the assignee. Absolute assignment: when the assignee receives full control of the policy and the right to the policy benefits from the current policy owner under an absolute assignment, the transfer is complete and irreversible, and the assignee receives full control over the policy and full rights to its benefits. Collateral assignment: this particular and temporary transfer of right to another person or entity. Collateral assignments are usually intended for securing a loan with a creditor. Collateral assignment is one in which the policy is assigned to a creditor as a security or collateral for a debt. If the insured dies or someone becomes totally permanently disabled, the creditor is entitled to be reimbursed out of the benefit proceeds for the amount owed. The insurance beneficiary is then entitled to any excess of policy proceeds over the amount due to the creditor. Free look: the policy owner is permitted a certain number of days once the policy is delivered to look over the policy and return it for a refund of all of the premiums paid. Notice of claims: the notice of claims provision describes the policy owner's obligation to notify the insurance company of a claim in a reasonable period of time. Typically, the period is 20 days after the occurrence or commencement of the loss, or soon thereafter, as is reasonably possible. You need to let the insurance company know that you are going to be filing a claim, so they expect your claim forms.